What's going on, everybody? Welcome to a Capital Hungry Market Analysis and Trade Ideas webinar. It is currently roughly 6:30 p.m. Eastern, Monday, October 16th. We're just going to be continuing from our previous Market Analysis and Trade Ideas webinar. So basically, we understand that we saw some more fear, uncertainty, and doubt arise that obviously change risk flows within the markets due to the escalations with Israel and Palestine. Now, a lot of that information got priced in accordingly with this move we saw on last Friday before market close, with gold rallying from the 1870s all the way into the 1930s here. Since then, we haven't had anything to reignite tensions or bring new escalations to the table. We've had some minor de-escalations instead, such as a call for a ceasefire and more diplomatic talks taking place between major countries' leaders. So we have to be careful here with gold, where of course we are still very bullish on the intraday timeframes and fundamentally speaking, but if we cannot be really printing new highs here, then we could easily be revisiting lower demand zones into the 1900s and 1897s before starting to see buyers come into the market. With the de-escalations that occurred over the weekend, as well as the ceasefire, we ended up already having this gap down, but did not get the full pullback phase just yet, before starting to consolidate through the remainder of the New York session there, as we had some less volume and volatility to start out the week with a lack of events. Obviously, we still have to keep an eye out on news headlines, but if we don't get any fresh escalations and US retail sales data tomorrow still remains relatively resilient, that can be the catalyst to lead to a short-term event-induced pullback on gold before starting to see buyers enter the market from lower demanded price points there, as stated into the 1897s and 1900s. So the same time we're seeing gold show those signs of exhaustion and consolidating, it's also being highlighted with some dollar softness, as well as equities showing a bit of pullback structure on the optimism of de-escalations, but still no major volume and volatility. So the main things we have to look out for now are really just any headlines that can either trigger further fear, uncertainty, and doubt through escalations. Examples of that would be more mass violence or other countries getting involved from a physical front. In the example of maybe Iran, or obviously looking at some of the NATO countries. And examples of ceasefire are obviously talking about finding more political and diplomatic solutions while avoiding violence, and even extending the optimism through that side. So that's what we're basically going to be looking out for within the news headlines, is either the news headlines are just going to be information that's already well known or priced in. Either it's a new event and it's going to bring fear, uncertainty, and doubt with the escalation, or it's an optimistic de-escalation point. Other than that, the main economic data in focus is some labor market reporting for the UK overnight, some economic sentiment reporting for Germany overnight through the London session, which will just impact euro pairs, and then really through the North American trading session, retail sales and industrial production data. Now, retail sales is expected to show a slight decline, but still be in healthy macro ranges. Inflation has still been relatively controlled, not seeing any major surges or spikes, just having some fluctuations back at baseline levels, and credit card spending has still been elevated. So we're still seeing credit card debt continue to increase from a consumer standpoint, of course, which just shows that even though interest rates are high, even though we're still having potential signs of policy lag effects and weakening economies to come, consumerism is still relatively healthy as individuals are going into debt, racking up more credit card debt to continue to be purchasing items that they more than likely don't need to be purchasing. So with this retail sales, I could personally see us still being better than this forecast and being neutral to optimistic data. If my prediction is correct that retail sales is still relatively robust, which also adds to the inflation picture as well, this can still keep dollar bullish while short term giving gold a bearish correction to retest into better buy zones. If my prediction is wrong, which is 100% possible, and retail sales is actually weakening, we're going to need the number to be lower than the forecast because the market is already expecting this and pricing this information in. So if we come out at 0.4%, even though that's lower than prior and showing a decline, because of the forecast, it's still considered optimistic data because it's better than what most people were expecting in terms of the result there. So if we want to see dollar weakness tomorrow and just gold hold more bulls from an economic data impact perspective, retail sales here, with the main one being the monthly change focus, has to be lower than 0.3, coming out at like 0.1 into the negative integer territory. That would be a catalyst for dollar to have another pullback phase to retest that same demand zone when we're going to look at the dollar index in a second, and also gold just to see more bulls coming to the table, going back into the 1930s and potentially 1940s. For USD CAD, we also have to keep in mind inflation data with CAD CPI, still expected to be relatively sticky back at baseline levels. Bank of Canada is expected, if these inflation levels are still elevated, to do another rate hike. And then after the new 4-hour candle, we have some industrial production data. This is expected to show a slight decline back to 0% after we've had some pretty healthy numbers here. Manufacturing PMI in durable goods has still been relatively solid. Policy lag effects are yet to be felt from obviously all of the monetary policy tightening. So with this industrial production data, it's also very similar to the retail sales, just in terms of the forecast, where if we want it to hold negative impact, it's going to have to come out lower than this forecast. A slight decline from prior will still show that the US economy is resilient amidst the tighter financial conditions and still not giving signs of a recession or anything of that nature, which would still be supporting US dollar bulls and short-term gold bears if we don't get any escalations with geopolitical tensions overnight or through the North American trading session tomorrow. Now, because of the main US data being at 8:30 a.m. Eastern, our New York scalping session is going to start at 8. So we can obviously see the New York Open, COMEX Open, and then go into this data release to potentially trade the volatility that gets induced from it for some scalp idea trades. Now, with UK jobs data, still expecting this data to be relatively solid. The main focus here is the payroll change, what they're expecting no change at all from the prior. It's the same forecast as prior, but we can see even from some of the headlines that we were getting from Bank of England representatives that they've highlighted the labor market still being relatively tight, inflation starting to go closer towards their goal, and them being pretty solid in terms of their path on fighting inflation. So this data could still be relatively optimistic, but I don't think it's going to hold too much weight unless it's an actual major change, exceeding minimum or maximum expectations there. What we're really looking at is that we're still in potential secondary phases of market structure when we're looking at dollar here, for example, where we could easily be still seeing downside moves to revisit this demand zone again before seeing any reason for upside volatility and buyers to repool in there. Otherwise, it's difficult to see dollar bulls unless we're trading back above 106.6. And with that being said, with volatility index softer and ranging, starting to fade some of the fear, uncertainty, and doubt, with the geopolitical tensions being priced in and some of the de-escalation points, with the dollar being softer there as well, Equities, we were looking for high risk, high reward sells here at 34K. But if we don't have any new fear, uncertainty, or doubt, or if we don't have dollar strength coming back into the table from an event leading to the market pricing in rates up higher for longer, which is bearish for equities, then we could easily still be seeing this pullback extend to like 34 300s previous lows here before starting to see sells. So we might see these pullback structures still hold some weight. Even with like pairs like Euro USD and GBP USD, we were talking about this with the last market analysis webinar. The sells we called in terms of retesting bearish market structure points and expecting last week's CPI to be higher, which would still lead to dollar strength. It was fantastic plays, but we still have to remain objective to both sides of the market, where as great as these sells were, it still didn't lead to any extensions of trend and new lower lows being printed, which means that we still have the possibility to see that secondary phase of market structure of creating a consolidation or seeing some pullbacks again before accumulating enough sell side liquidity and continuing the trend. I can give you guys a quick example right here where you get that happening a few times. So here you can see from these previous lows, and it would line up with a key level more than likely as well, here being 1.28 flat, right? 1.28 is a sell side liquidity zone while we're overall in bearish structure. You can see the lows printed exactly here as we broke lower and started to have pullbacks into this area, right? So we have these lows printed, support area for that time. Now you can see, sticking with the trend and still having macro dollar strength, from this sell side liquidity zone, you can get fantastic scalps and day trades that are hundreds of pips, come down all the way right down to the lows and so forth. But you don't actually get any extensions of trend until weeks later there, right? So you can see you're still respecting bearish market structure. You're still respecting the fundamentals of dollar being a lot more bullish on the Fed's pushing the narrative of rates up higher for longer. You're still getting fantastic sell plays of 140 pips, 100 pips from that sell side liquidity zone. But it isn't until 21 days later where you actually break the lows and extend trend, get one more minor pullback phase into that accumulation area before continuing further, right? So that's something we have to be careful here, especially when we're looking at dollar individually. And when we're zooming out, we can see that it looks like dollar starting to create more of a higher time frame range. From your general lows to general highs here. Right? Still bullish in structure, still having this buy side liquidity zone being respected. But even though you're getting fantastic dollar bull plays with the trend, we're still not extending trend and seeing new highs being printed. The upside volatility is being subdued. We can also see, even with some of the headlines, I don't know if you guys noticed in the newsroom, it might have been missed because of all the geopolitical tension headlines. But just last Asian session, India was seen doing currency intervention to prevent the free fall of the Indian rupee, right? Prevent the Indian rupee from breaking record lows due to how strong the dollar's been against all of these other foreign currencies. So India, even last night during the Asian session, was doing currency intervention. Let me see if I can quickly show you guys that here. Can't find it right away here, but it was last night during the Asian session. I don't want to waste too much time on it because it's not that important. But it's just another factor of why we may see, from a technical standpoint, dollar ranging. If data is just more neutral to mixed, we're not getting any exciting results with economic data, bringing more optimism for dollar strength. If we're seeing some de-escalations with geopolitical tensions and not getting any fresh global fear, uncertainty, or doubt events to fuel demand in the dollar, if we're seeing these other countries doing these currency interventions to subdue dollar upside volatility, then obviously those are all catalysts that can lead to deeper dollar pullbacks, or just the secondary phase of market structure being a consolidation being created there. So here, this is it. This was around 11:30 at Asian session last night. So India central bank likely selling US dollars to keep the Indian rupee off a record low, a form of currency intervention, which obviously is going to decrease the confidence, as India is still quite a large country, of buyers starting to pool into the dollar. Even with the data we had today, where it was still better than the forecast, we still didn't see any major upside volume in the dollar. And of course, due to the lack of geopolitical tensions, we didn't see much volume. So I wouldn't be surprised where the secondary phase of market structure is a consolidation being created here on the dollar index, which if we don't get any individual catalysts on pairs like GBP and Euro USD, we're going to create a range down here at these lows as the secondary phase. And it's going to be a pretty similar idea like what we've seen here with GU, except down at these lows here, where we may remain in this range for an extended period of another days or weeks. Don't forget, with these geopolitical tensions and the escalations of conflict between Israel and Palestine, this isn't something that's just going to be like a light switch and it's going to be like a 3-day event, or it's going to be completely over in a week. It's going to be something that's now going to be in focus for the markets over the next weeks and months to come, where you're going to have mixed periods of optimism and diplomatic talks and ceasefires. And then you're going to have mixed periods of fear, uncertainty, and doubt, with escalations of mass violence and other countries getting involved, right? So we can see markets are more on edge because of that. And that's a very common pattern during these geopolitical tensions, as their timelines can extend for quite a long period there, right? But anyways, I do see that dollar can probably just be creating a higher time frame range. We're still going to be sticking to the bullish side and can't really see clean dollar bears unless we're technically trading below 105.4s and have a fundamental reason for that. But dollar remaining subdued in this range on the higher time frame looks very highly likely, in my opinion, as the secondary phase of market structure. Now, with Japanese yen is still very bearish and relatively soft. A lot of the fear, uncertainty, and doubt regarding the Israel escalations have been priced in. Obviously, we've had some de-escalations over the weekend. The one thing we have to worry about is Japan's Ministry of Finance digging into their currency reserves to do currency intervention. Now, as I was speaking about it in the last webinar, right, the action of them doing currency intervention, it's not free. It comes at a cost. They have to dig into their currency reserves to do that. And to continuously do that from the same prices and not really have much of an impact on yen's devaluation is just a net negative choice to make. It's just a poor decision to make, right? So we may not see a currency intervention until UJ reaches higher prices like we were talking about. UJ might go to 151 this time, those exact same previous peaked highs we were talking about here, before we maybe see another currency intervention. So we may still have another 100 pips of upside that UJ can peak up to before we see a currency intervention. Them digging into their reserves last time was literally a 1 4-hour candle impact. It didn't shift structure at all. It didn't lead to yen falling at a much slower rate. We're back at the same lows on the yen. And are they really going to keep digging to their currency reserves to do interventions at the same price for a 4-hour impact before continuing the trend? I don't think so. I think they may be a bit more strategic with their interventions and let higher prices being hit. And as long as the upside volatility isn't excessive, if we're slowly creeping up over a period of days and weeks up to the 150.5s, then it makes sense. But if we see excessive volatility going to the upside, then obviously that's a sign that can trigger them doing currency intervention. But I still want to be playing Japanese yen weakness. We just have to keep in mind those currency interventions that the Japan Ministry of Finance can do at any time. All right, so now with gold here. So obviously we know gold is in bullish structure. We're creating some nice structure here as we had the accumulation from the 1820s higher time frame demand zone. We predicted as we came to this demand zone, we would see banking sector failures. I was specifically calling Wells Fargo collapse, but instead, the fundamental catalyst that brought fear, uncertainty, and doubt was Middle Eastern tensions escalating. Very nice impulsive moves. We've had these corrections to accumulate more order flow. This higher low created from the CPI day. And then obviously the Israeli 24-hour evacuation threat on Friday led to this impulsive move. If we cannot print any new highs or dig into these highs, and if we do not have any fresh escalations of Middle Eastern tensions, keep in mind, this is a timeline that's going to be extending for days and weeks. If we see further headlines of diplomatic talks and ceasefires or anything of that nature, then we could easily get a 50% correction of this impulsive rally, push price down with buyers exiting positions and sellers jumping in hand to retest lower demand zones before accumulating buy orders from better prices before continuing the trend, which I could easily see coming into the 1897s and 1900s. Otherwise, I don't really want to be buying at these last FOMC high prices, digging into historically high prices after such an impulsive rally without fundamental catalysts to support it. Overnight, if mass violence escalates even more, we see maybe Iran get involved when they said they weren't going to, or we see Israel follow through with that threat and start launching more mass attacks, right? Then, of course, you have a fundamental reason from current prices for more demand to be pooling in, where you can ride that wave with easy confirms above these highs, continuing our macro trend and what we've been talking about from our higher time frame webinars. Otherwise, even just from a psychology perspective and even just from a preference, I would prefer to get a pullback, some type of correction to set up buys from lower demanded prices before continuing the trend. And I also don't want to be getting trapped in these highs if we don't have any fresh escalations of fear and we can see de-escalations leading to a bit of a correction first. You can see we did a good job about predicting that we'd see de-escalation over the weekend and back testing the timeline of previous Israel versus Palestine geopolitical tensions. And luckily, nobody got caught just buying on this way down, right? That's almost right. Even here is like a 200 plus pip correction. So a lot of people that are just looking from a technical only standpoint, or they don't understand the pricing in concept of how events get priced in, they're still looking at the mainstream media and CNN or looking at breaking news on Twitter, and they're still seeing, oh, more rockets are being launched, more fears there. Let's keep buying gold. And they'll keep buying gold this entire time, taking stupid losses, not understanding how fundamental events get priced in, how the market moves in waves, how you have these corrective phases, accumulation phases, before having the order flow to be continuing with the trend, right? So We haven't had any fresh escalations. We've actually had the ceasefire. It's very difficult for me to see gold buys unless we're trading above 1930 and 1932. This is easy continuation moves, fresh escalations. Otherwise, if we can't break below 1925 and we still come below this intraday gray zone and key level, I can see us retesting that 50% correction point, subjective trend line, and higher time frame key level at 1902 and 1897 before attempting buys again. Where if we don't get any fresh tension escalations, and if US economic data still remains more neutral to resilient, that can be the short-term catalyst to seeing these corrections of failing to break 1925, breaking below 1912, and breaking below 1915 here. So I either see a corrective phase of playing the corrective sell short term first to better buy zones, or only see us buying from these highs if we can start to see breaks above the highs from a technical standpoint that's being supported by fresh escalations, which is just a clear indication of more demand in gold and appeal to its safe haven side. Now, dollar pairs is going to be pretty simple, where I'm just expecting us to stay in this general range. And we could easily be playing some very simple range trades if we don't have the validation to be continuing trend. Now, based on obviously some of these countries doing currency interventions, a lot of the Fed's hawkish pressure being priced in from the last FOMC, Fed speakers specifically over the last couple of days having a more dovish tone, confirming they don't need any more rate hikes. Inflation is starting to look a lot better, and they're taking a data-dependent, slow and steady approach, which obviously is going to support some more greed and equities optimism short term. We can easily see dollars showing a secondary phase of market structure, buyer exhaustion, and just starting to consolidate, with then leading to the correlation on pairs like Euro USD and GBP USD of just creating a consolidation phase. So if on Euro USD we come to 1.0525, break above these current candle bodies, I would see short-term buys to the same range highs, same liquidity zone before again attempting sells. Just like we were talking about on that example of GBP USD, of understanding the fundamentals that lead to the change in different market structure phases. So if we can anticipate a larger range is going to be created, we don't have the confirms of dollar strength printing new highs or Euro USD and GU breaking new lows, then we're going to be playing this range accordingly. But still, when we come to our higher time frame price points of interest, still looking for our main bias plays, right? So in the example, another example, fantastic example is like this on Euro USD. Very similar to what we were looking at on GBP USD. You identify that you're still in bear structure, which we are on the macro due to dollar domination from Fed sticking to rates up being higher for longer. The lows printed, you have your general low area marked out. The sell side liquidity zone still gets absolutely respected, but for that timeline, you don't actually end up breaking lower until weeks later, right? You still have these plays within the range where you can take advantage of some counter trend trades, scalps or day trades, being selective and patient, not needing to catch every single opportunity, but you're still respecting the higher time frame bias as well. That's exactly what we're looking at when we're looking right now. Still very bearish in structure. Macro fundamentals still stand. But it looks like we're going to be sitting in this range until we have more fundamental reasoning for dollar to extend higher or more geopolitical tensions arising to lead to an outflow out of risk assets and risk currencies and more demand in the dollar. It seems like we can just be playing in this range, which means short-term buys, but still would be looking for sells in the same sell side liquidity area. Does that make sense to everybody on dollar pairs? With the example we gave on GU, Euro USD, looking at dollar individually. Short-term de-escalations line up with that as well, right? If we don't have any fresh geopolitical tensions to lead to less inflow into Euro assets and more inflow into US dollar, then we could easily still just be playing within this range, still just retesting the exact same sell zones. Short-term key level 1.0525, 1.056, retesting the same sell zones, playing this higher time frame range. GBP USD is the exact same idea. Obviously, safe continuation sells if we have fresh geopolitical tensions rise, less demand in the British pound as it's still a part of your basket of risk currencies, where the US dollar is still seen as a safe haven and your world reserve currency. But if we don't break below the lows, here I would still be looking for these short-term buys to retest the same sell side liquidity zone. $1.2165, 1.22, 1.224. But as we still come to retest bearish market structure based on this price points here, would still be looking for sells from that same 1.232 we were talking about from previous webinars and 1.236. Basically seeing more of a larger secondary phase of market structure being created at these lows in bearish structure. Very similar to this period of time here. That's what I see taking place here. Remember this drawing, as we'll break lower as tensions escalate going into deeper the end of the month. All right. Now, USD CAD has very aggressive pullback waves. I could still see short-term downside in bears to retest 1.355 for buys or 1.348. If dollar's more bearish in the range, oil still remaining relatively resilient, Canadian CPI tomorrow still elevated, showing the Bank of Canada needs to keep the pressure with rate hikes, then we could easily see UCAD digging down to retest and giving us short-term sell plays from current prices to look for buys at 3.5 or 3.48. Otherwise, it's hard to jump back into buys with the current exhaustion on dollar and potential for Canadian dollar to get a little bit of a boost with CPI data tomorrow, still being volatile in the sticky zone back at baseline. UJ still in a bullish bias on yen pairs, like GJ can still be digging up to the same exact range highs before we see signs of exhaustion again, right? Just like when we were back testing how during times of fear, uncertainty, and doubt, that goes against Japanese yen bears. Like, for example, the banking sector failure early 2023, that you can just have these larger ranges being created of hundreds of pips for an extended period of days and weeks. Ever since we've had the Middle Eastern tensions escalate and we broke below this demand zone here, that's pretty much looks like what's been created since the Yentervention and then the Middle Eastern tensions escalating. Is just a larger, higher time frame range. But the macro is still very bullish for GJ. We don't have any fresh fear, uncertainty, and doubt yet Obviously, we need to stay very sharp and vigilant with the headlines. Thankfully, we got the capital hungry newsroom on deck, right? Super fast. But right now, we've had de-escalations. So Japanese yen is back to its macro sentiment of being bearish on the ultra loose, dovish policy positioning of the Bank of Japan, and just in very strong bearish price action structure. And GJ could easily just still be digging into these same highs before showing signs of exhaustion, which is still like another 100 pips to the upside. Very difficult to see any further corrections on GBPJPY here if we're still holding above 181.5 and if we don't get any fresh escalations with fear tensions. It looks like we're seeing a lot of the fear being fizzled up and starting to see more of the diplomatic political side starting to come into market focus. And remember, a lot of these geopolitical tensions, everybody from a trading perspective, they're just looking for something to escalate right now because they want to take a trade. The true reality of these wars is that they extend over weeks, months, sometimes even years. Market focus never lasts that long, but just from an educational standpoint, understanding that. So I'm still bullish on these yen pairs, especially from what we were talking about during our New York scalping session. On UJ, I still see us digging up, respecting 149.5, 149.8, breaking above 150s for buys. Even a pullback to 149.2, still looking for buys on UJ, just being mindful of currency intervention. But I think they have to be a bit more strategic with how they're digging into their currency reserves, as the last one really, really had such a small, minimal impact. On GJ here, I can only see deeper corrective sells below 181.5. Otherwise, if the daily candle just makes that lower wick and we break above these prices and don't have any new fear, uncertainty, or doubt, we just have the fear, uncertainty, and doubt from last Friday priced in, de-escalations holding the most weight for the time being, just general noise in headlines, but not anything new for the market to focus on and price in, then yen weakness can still hold out and GJ can be going bullish just back into the range highs before seeing signs of exhaustion. Otherwise, I can only see sells below 182 and 181.5. Last but not least, US 30, I can still see with volatility index relatively flat, fear, uncertainty, and doubt priced in, buyers grabbing the dip here, the secondary phase of market structure extending deeper into potentially 34 300s before us starting to attempt sells again. Or I'd only be looking for sells back below 33 850s. But I don't want to ramble on too long. Still looking like if we don't get any fresh geopolitical tensions, volume and volatility will be subdued. A lot of the events from the previous week priced in. We do have a lot of Fed speakers scattered throughout the week, which they've been more on the dovish side so far, a bit more optimistic with the fight on inflation. Just be very careful with the few reactive catalysts that we have to focus on, which the number one primary one is the Middle Eastern geopolitical tensions, of looking at headlines and either assessing if it's just general noise that's priced in, not holding weight, if it's a new escalation point, bringing more fear, uncertainty, and doubt and changing risk flows, or if it's any de-escalation points like we gave examples of. The second one is obviously stealth currency interventions from Japan's Ministry of Finance. And the banking sector failures, I'm still expecting that in going into the end of Q4 into Q1 2024. So don't lose sight of those either.